Okay, now we're back. A contingency there on page 212. A contingency is any set of conditions that both the buyer and the seller agree upon that have to be met before the purchase agreement's in full force. All right? There are three common contingencies that we use. The appraisal contingency, so if the house is not worth what we agreed on, then we're out. All right? The property sale contingency, that's the one that's popping itself up right now. I'll buy your house, but I've got to sell mine first before I can buy yours. If I can't, then I'm out of the purchase agreement with no harm. I get my earnest money back because you accepted it knowing I have to sell my house. That's how we bought the house that my wife and I just bought. The other person had a sales contingency in their offer. We put an offer in. The agent called us and said, hey, does your offer have a contingency? It doesn't say it does. I'm like, it doesn't. I don't have to sell my first house to buy this one. So he said, okay. So what happens is he calls the first guy and says, that contingency that you've got, you now have 48 hours to remove it or you're out of the deal. Called us back 2 days later and said he was not able to remove the contingency. You're up. And we bought the house. All right? So that's kind of a common one. Another one, obviously, is the mortgage contingency. If I can't get a mortgage, I'm not a buyer. Remember back to the one of the three words that describe a buyer? Ready, willing, and able. And I told you that. Can't get a loan. You said, oh, I got to get a commission. No, can't earn a commission because that's a contingency that says they really weren't a buyer. All right, I'm talking about a buyer that just says, I don't like purple, I'm not buying. That's different than a buyer that says, I can't get a loan, they're not a buyer. All right? Now, there was a really good argument the other day, a couple weeks ago, on our Facebook page that I really read the argument, both sides, and I'm like, oh, I agree with both of them. And here's how it went. And I know how it turned out, which is probably the way I would have leaned on the most, but the other guy made sense. Mortgage contingency says, if I cannot get a mortgage, I get my money back. Earnest money in the event that the buyer is unable to secure the mortgage to the property. So he can't get a mortgage, I get my earnest money back. So this guy couldn't get a mortgage, he asked for his earnest money back. The seller said, no, because the reason you couldn't get a mortgage is you went out and bought a car in the middle of the process and did it to yourself. That makes sense. I could see his side of the argument. It's not that you couldn't get a mortgage. The fact is you made it so you couldn't get a mortgage. Because you had a pre-approval, but you changed your credit score and your debt-to-income ratio by buying a car in the middle. Now you can't. And he argued, I would lean on he should get his money back because I think our purchase agreement says for any reason, which would include dumbass reasons. All right? So if I can't get a mortgage for any reason, I get out of the deal, which is what ended up happening, and they gave their earnest money back. But he made an argument, hey, what do you guys think? And there were a lot of responders going both sides of the way. And I thought, hey, I can agree with that. You know, but of course you can never underestimate the human to be stupid. They may not have known that they couldn't have done that, all kinds of weird stuff. And I got some good stories coming up in the mortgage when we get to 14 and 15 about things that you've seen that you just go, huh? Really? You did that? All right. An amendment and an addendum. No one asked, so I'll tell you now. This is how we novate contracts. When I told you we change stuff, it's called a novation or to novate. This is how we do it. We use this thing called an amendment or an addendum. An amendment is very long for the word amend, which means to change. So an amendment is used when you have agreed on a term and now you got to change it, like the closing date or the purchase price or whatever, you would send an amendment to the purchase agreement. We agreed on closing on October the 13th. My guy's golfing with your guy, so we got to move it to the 15th. I would send an amendment to you that would say closing date to be moved to October the 15th. My guy has signed it, your guy has signed it. Now we have a purchase agreement that has been amended with a new date. We have novated the contract. Same two guys change the contract through an amendment. That's very common. That's the form we use. It's called an amendment to a purchase agreement. The other form is called an addendum. Has the word add. Something you haven't talked about. Like, oh, and by the way, we want the washer and dryer. Okay, we're going to put that on an addendum because we didn't talk about it here in the purchase agreement. Neither one of us thought about it. We want to add it to the purchase agreement. That would be an addendum. A lot of times personal properties get placed on addendums. You deal with the real property in the purchase agreement, and then you add this addendum that says, oh, and by the way, we want the washer and the dryer and the pool table and the swing set out back. And you have an addendum to the purchase agreement. And then it forgot to get sent to the mortgage guy. So they don't see that. No, don't do that. That's called mortgage fraud. All right. Options, we've already beat up options. Taken out by the optionor is the one that gives it to the optionee. There is option consideration because an option is a contract. It's just unilateral. So when I pay that guy that $1,000 for the option to buy property, that $1,000 is a consideration. Why do I need that? Because all contracts have to have consideration. So he'd be the optionor, I'd be the optionee. All right? Now this last thing I want to talk about is called equitable title. And I told you, if you remember, quit claim was my number one pet peeve. People call it quick claim. And then I told you number two pet peeve. I got so many I have them numbered. All right? Number two pet peeve is that whole thing. It's a selling agent that works with buyers. People call me all the time. Here's the third pet peeve. There is no such animal as a rent to own. Doesn't exist. Can't exist. It's just illiterate people using what they think are real estate terms. All right? When we use a sale, it's called a grantor and a grantee, right? Seller and buyer. When a grantor and a grantee sell property, how quick does it happen? Reach up, take the deed, title's transferred. It happens instantly, right? So it's instant. We also have this terms called a lessor and a lessee. Lessor is better known as a landlord. Landlord, the one doing the leasing. The lessee is the legal term for the tenant. This is a trick question, so don't get fooled. How quickly does the property transfer ownership? Never. All right? It's a lease. It's not a transfer of ownership. So what you have are these two conditions of when property transfers, right? Instantly and never. Well, lo and behold, we actually have a third way to transfer property. It's over a period of time, slowly. We can't use either one of these four words, so we've got new words to deal with. The word is called a vendor and a vendee. The property transfers over time, more commonly called a, not rent to own, it is called a land contract. Let's go back and slay that dragon one more time. Lessor, lessee. What's the money called that they exchange hands? It's called rent. Well, you just told me ownership never transfers. How could there be rent to own then? There is no such animal. Can't happen. All right? There is no such way to pay rent and then own it.
So with the land contract, do you need to file something stating that...
You file a land contract.
I mean, but do you file anything else, like with the title company or anything?
You could do a closing on a land contract. Works just the same as that. What you are transferring is equitable ownership to the proper person, not actual ownership. A grantor transfers actual ownership like that. A vendor will transfer equitable ownership, or a lot of times you hear it called equitable title, to the vendee. His equitable title means he has an interest in the property. He doesn't actually own it yet. The amount of ownership is based on a proportional monthly payment that he gets credit for. So what happens is you get this. Here's how the property transfers. On a grantor grantee, it goes boop. Transfers all at one time. On a land contract, here's what happens. Every time they make monthly payments, the amount of ownership transfers so that there is a gradual transfer of ownership, and when they're finally done, then they deed him the property. All right? It's not rent. It's a land contract. So there is ownership here. Vendee has equitable title. The vendor has actual title. He still owns it.
So if they were ever to sell a property with that,
Who's selling the property?
what if the vendee wants out?
He can't. It's a contract.
Well, if they want to sell and then the vendor wants to...
They don't have all the interest in the property.
Can the vendor sell some or sell his?
Yes, the vendor can sell the property.
They have more...
He would just look at it like kind of a lien.
That's what I was going to say. Can you put a lien on it?
Well, he doesn't have to put a lien. The land contract is a lien.
Okay.
All right? So the vendee can say, oh, I want to sell the house. I own 50% of it to $50,000. I still have a land contract for 50 more, but I'm selling the property for 110. So when I get my 110, I'll pay this guy off. Now I have actual title. Now I'll sell my 50 and the title moves on. All right? So the vendee has equitable title. What does word equity mean? Money. So his equitable title is based upon, in some fashion, the amount of money that he has given to him. As he gives more money every month and eventually over the years, he has bigger and bigger and bigger equitable title. The vendor still has the actual title in his name. Rent is used under a lease. At the end of the lease period, there is an option to buy it. So you can have a lease option, 2 documents. One's a lease, one's a document. All right? One's a lease, one's an option. So they become a tenant during the lease. At the end of the lease, I have an option to buy the property. But during the lease period, I'm not the owner. I'm a tenant. And you can't give ownership during that with a rental payment because that is a
Yeah, we have the same thing going on right now.
land contract. And judges have ruled over this plenty of time. You can call it whatever you want to call it. A rose by any other name is still a rose. You call it a lease option or a rent to own, not a lease option, misspoke. You call it a rent to own and you're giving ownership with every monthly payment, the judge is going to say that's a land contract.
Yeah, because he's trying to say that, like he's trying to question how much we're selling it to him. And
He's trying to question how much you're selling it to him. Why?
there's already $12,000 in equity. Like it was appraised for 80 and we're selling it to him for 68. But he's trying to
Okay? What's it not cheap enough for him? Even though he's got 12 grand of equity?
I guess not.
Yeah. It's not free enough. Make it freer. So there is no such thing as a rent to own. It's a lease with an option, or it's a land contract. Those are the only two things. You cannot rent to own property. Those words don't go together. Rent is with a lessor and a tenant, and you pay monthly rent. Ownership comes with either the grantor and grantee, or in some form of a vendor-vendee. All right? So now when you're driving down the road and you see all those signs rent your own, you guys can just laugh, because you know that's probably somebody that bought the $49 course late night on TV and is now an investor and goes, oh, I'm going to make $1 million in rent to own. First time they go to court, the judge is going to go, that's a land contract. Now, if that's not big enough, here's the big kicker. As a tenant, if you violate the lease, that's a small claims court, probably 2 to 3 weeks to evict you. As a vendee of a land contract, I have to foreclose upon you to get my interest back. It works because there is an equitable interest in the property. As a tenant, there's no interest other than the lease. All right? So as a vendor, if my vendee quits making payments, I can't just evict him and kick him out. No, I got to go to court, foreclose, get him to deed the property back or take it through foreclosure. Now I got the property back. So I tell all my investors, you should sell on a lease option and buy on a land contract. You want to be able to kick out the people that are troublemakers to you, but you want to be able to have some protection in case you're the troublemaker. All right? So sell on lease option, buy on a land contract. Sometimes you also hear it called owner financing, and you can record it. Title company will close it and everything. It's an insured closing. A lot of people don't want to close it because they have an underlying mortgage that could get, and we'll talk all about purchase money mortgages and liens and all of that in chapter 14 coming up. But title company will close a land contract. You now have an equitable interest. They record it at the recorder's office. It shows up. All right? This also may be another reason why your tax records don't match. If you remember yesterday, I talked about the Smiths call you and say you want to list a property, and you look at the tax record and it says Jones, and you call them back and say, what the heck? They go, oh, we're buying on land contract. It just wasn't recorded. So we have an equitable interest which we can sell. It just still shows the original actual owner on record. That'll happen. You can get that. All right? Any questions about contracts, how they work? Going once? Going what?
Vendee is in default, so it's a complete foreclosure process.
Yes, if the vendee goes into default, it's a foreclosure process. Probably. Once again, two people under contract can agree to do anything if both parties agree. The vendee could go into default. The vendor call him and say, I want you to quit claiming your interest back to me, and I won't take you to court. If they both agree, they can do that. Why would the vendee quit claim his interest? What's his interest? Well, the vendor knows his interest because the vendor is the one that gave it to him. So the vendor can take a quit claim from the vendee and surrender your rights. Of course, you're surrendering all the equity that you may have in there, but that's the price you get paid.
Would you write that into the contract possibly?
You could possibly write that into a contract at some point, and there are all kinds of tricky ways that I've seen investors try and do that. If you don't have a certain percentage earned before you default, then you automatically surrender and you quit claim me. I saw one guy that they wrote the vendee signed a quit claim deed in advance, and it wasn't to be executed unless there was a certain percentage behind, then that was automatically executed so that you didn't even have to wait on the vendee to sign the paper. I don't know if it worked out. I don't know if it would stand in court, but that was one thing somebody came up with. Hey, you pre-sign so that I'm holding it, and if you default, I'm going to go down and record this quitclaim, and I'll get it back without any argument. So it's a foreclosure because you have to give back the equitable interest. Unless the vendee says, yeah, hey, you know what, I want to avoid all this trouble, I'll quitclaim you the house back, and I'll walk away, and the vendor says, okay, as long as I get my house back in good condition, of course you're surrendering all the money that you paid. Okay, I agree with that. They can do that. If he says, no, I want you to go to court, then the vendor has to go to foreclosure court to get the interest back from him. All right? Have a good day.